If you're looking for the best exchange-traded funds for your portfolio for 2022, there's no shortage of excellent options to consider. The beauty of ETFs is that you're able to get a slice of hundreds of companies in one fund, which offers diversification and stability with a set-it-and-forget-it approach. Two of the safest ETFs available are VOO and VTI, both from Vanguard. Both follow the top-performing large-cap companies and have long histories of steady growth. Although both of these are solid choices for long-term investing, in the current down market there may be benefits to one over the other. In this video, we'll examine some of the key similarities and differences between these two popular funds. Should you focus on one of them, or even both of them, in 2022? What are VOO and VTI ETFs? VOO and VTI are the ticker symbols of two Vanguard index ETFs. Exchange-traded funds, or ETFs, are a type of pooled investment security that trades like a stock on the market. They both track a particular index and contain a wide range of investments. Many investors appreciate VOO and VTI for their broad exposure to the stock market, although VTI has a much larger pool of stocks of about 4,000 in all. The broad holdings within these ETFs can reduce investor risk. For investors with a long-term horizon of at least 10 years, VOO and VTI both offer strong returns that can outweigh any short-term losses. VOO represents the Vanguard S&P 500 ETF, so it's a basket of securities tracking the S&P 500 index. The S&P 500 is a compilation of 500 large-cap U.S. companies and is one of the most closely followed indices in the U.S. market. Large-cap companies tend to be relatively safe, but often don't offer the growth potential of smaller companies. VTI is the Vanguard Total Stock Market ETF. This ETF tracks the CRSP US Total Market Index with 4,076 total stocks. It holds almost 100% of the investable equity market in the US, with a median market cap of $124.9 billion. Currently, VOO's top 10 holdings are the same as VTI's. This is normal, as VOO and VTI have remarkably similar makeups in terms of the securities they hold. Now that we have an idea of what these funds comprise, how have these ETFs performed recently and over time? Both present a means of passively investing in the stock market with similar returns on your investment. Over the past several years, VOO has gone up in market price, with the exception of 2022, which is no surprise with the market as a whole dropping significantly. Overall, since its inception, the fund was up 13.29%. Comparing annual returns of both funds, in 2021, VTI returned 25.64% by market price, while VOO returned 28.6%. They turned in similar performances in the market for investors. When looking at quarterly returns for both VOO and VTI, the two ETFs again gave similar results. Both had quarterly returns around 6% for quarter 1, went up slightly in quarter 2, dropped to nearly zero in quarter 3, and jumped back up by the end of the year. Both VOO and VTI have performed at a decline over 2022, so whether you invested in VOO or VTI wouldn't have made much of a difference. However, in previous years, VOO and VTI have done well. In terms of dividends, both funds pay dividends to shareholders on a quarterly basis. These are payments from companies that reward their investors for their trust. As an investor, you can enjoy not only the returns on your total stock holdings as they, hopefully, grow in value, but also steady income from dividends paid by some of the companies in the fund. The VTI dividend yield is currently 1.59%, and its annual dividend is $3.04. VOO offers a comparable dividend yield of 1.65%. However, despite their overwhelming similarities, these two ETFs do have some slight deviations from each other. The makeup of the funds has some differences, since VOO basically tracks the S&P 500 and VTI tracks the entire stock market. If you'd like to focus your portfolio primarily on large companies, VOO will generally perform the same way as the S&P 500. If the S&P 500 gains in value, VOO will show comparable gains, and the reverse is also true. But if you're more invested in an all-encompassing stock market investment, VTI could be a better fit. VTI contains about 8 times the number of stocks as VOO, so it instantly exposes investors to a wider range of companies. Plus, VTI isn't as heavily weighted to large-cap companies. Large-cap companies generally have at least $10 billion in market capitalization, or the total value of outstanding shares. Mid-cap companies hold between $2 billion and $10 billion, while small-cap companies hold between $300 million and $2 billion. In general, smaller and mid-cap companies can be more volatile than large-cap options and suffer more from big market swings. The long-term investor is better prepared to absorb losses from temporary swings, so small-cap and mid-cap companies are still solid investments. Given that both VOO and VTI offer exposure to a wide range of securities with fairly low fees, deciding between the two might be tough. We say, why not choose both? If you have the opportunity to invest an equal amount in each fund on a monthly basis, that would probably be our favorite choice. However, if you know that you'd like a bit more exposure to smaller and medium-sized companies or just want to invest in more stocks overall, VTI is your best bet. VOO, meanwhile, is the better option for investors who want to focus heavily on large-cap companies.